Shares of First Republic Bank plummeted as much as 50% on Monday, deepening recent losses as investors feared the $30 billion pumped into the troubled lender last week by several big U.S. banks might not be enough to keep it afloat. S&P Global downgraded First Republic deeper into junk status this week and said the recent cash infusion from the 11 large banks may not solve its liquidity problems. A report from the Wall Street Journal said J.P. Morgan Chase CEO Jamie Dimon is leading talks with the heads of other big banks about fresh efforts to stabilize First Republic. Anna Rathbun is Chief Investment Officer at CBiz Investment Advisory Services.
What has happened is that the $30 billion injection is just an injection. It has not actually added any equity to the banking balance sheet. So what the investors are afraid of is, okay, we now have this short-term solution, but it's not a long-term solution, and equities are actually a long-term instrument. And so when the markets look far out, they're thinking, what next? Certainly any big bank, any large bank could buy First Republic. It doesn't have to be JP Morgan. JP Morgan could do it. I'm not entirely sure that JP Morgan would have the appetite to take in First Republic. They may have to divvy it up. It might not be one bank that buys it. It might be sliced and diced. We don't know that yet. I'm sure that that is not the desirable situation for First Republic, but that is what is on the line.
A wave of withdrawals had hit the San Francisco-based lender after the collapse of Silicon Valley Bank earlier this month. As fears persist, First Republic's shares have fallen more than 80% in the past 10 trading sessions. The New York Times reported late last week that First Republic is in talks to raise capital from other banks or private equity firms by issuing new shares and could also negotiate a deal to be sold. On Sunday, Reuters reported that First Republic was still trying to put together a capital raise, but that no deal was imminent.
Oil prices dropped to their lowest levels in 15 months on Monday on concerns that a global banking crisis could spark a recession that would reduce fuel demand. In volatile trading, global benchmark Brent crude and U.S. West Texas Intermediate crude each fell about $3 a barrel to their lowest levels since December of 2021. WTI sunk below $65 a barrel before paring some losses. Brent was trading at around $72 a barrel. Brent hit a 14-year peak of around $130 a barrel a year ago and was one of the main drivers of global inflation. It was above $100 a barrel as recently as July. Crude's Monday slide came despite a historic deal in which UBS, Switzerland's largest bank, agreed to buy Credit Suisse in an attempt to rescue the European country's second biggest bank. After the deal was announced, the U.S. Federal Reserve, European Central Bank, and other major central banks pledged to enhance market liquidity and support other banks. Given the recent turmoil in the banking sector and fears it could trigger a long-feared recession, traders and economists remain split on whether the U.S. Federal Reserve will raise its benchmark rate when policymakers meet this week. Some executives are calling on the central bank to pause its monetary policy tightening for now, but be ready to resume raising rates later. Meanwhile, one oil analyst tells Reuters that the oil market is moving more on fear than fundamentals, saying, quote, "We're not moving at all on supply and demand fundamentals. We're just moving on the banking concerns."